Hey, good morning. I'm John Cash. I'm the CEO of URE. We are a uranium producer in the great state of Wyoming. We have two flagship properties, Lost Creek, which has been in production for 8 years. And we also have a fully permitted project called Shirley Basin, which is fully permitted. And we are excited to get that up and running when the market conditions allow. So it's an exciting time to be in the market. The wind is at our back, and looking forward to moving the projects forward.
Good man, Sean. Lovely to meet you. We've been talking with Jeff. In fact, we haven't seen him for about a year, but we've always had a fantastic conversation with him about the travails of the geopolitics in this space. But looking forward to hearing the story, your version of the story here today. So what's happened there? Jeff just stood back and is acting chairman now, and you kind of stepped up the CEO role. I mean, what's happened?
Yeah, no, that's exactly right. So in March, he decided it's time for him to step down and retire. So he's moving toward that direction. He's not retired yet, but I took over as the CEO at that point, and he's going to continue on as the chairman of the board and president through our AGM, which is scheduled for June 2nd. So he's still heavily involved. I talk to them several times every day, and he's been a great mentor and some big shoes for me to fill, that's for sure. And but like I said, it's the wind's at my back right now. It's a great time to be jumping into this position and looking forward to trying to fill it as best as I possibly can.
Okay, and you were VP Regulatory Affairs before that. So have you ever been a CEO before? And so what were you doing in the company before you asked to kind of step up to the plate, as it were?
Sure. Yeah. No, I've never been a CEO. First time in that role, but I've been involved in the uranium space for a long time. In fact, I started back in 1994 with this in uranium back when I was in college. In fact, I worked for a couple of the majors at that point doing exploration for gold and uranium. And from that point, moved on and worked at Smith Ranch for a number of years doing regulatory affairs, but also exploration geology. Ultimately got the call from URE back in 2007. And it was too good of an offer to pass up. So I made the jump to URE. Been with them ever since, a number of roles with them, including regulatory affairs. In fact, I was the one that permitted both Lost Creek and Shirley Basin. So I'm intimately familiar with our projects. And so did that, done a lot of things with the company, did a little bit of lobbying, permitting, help out with a little bit of production. And so I have worn a number of hats in the company and across the industry. So I'm pretty familiar with the company and the projects, but yeah, it's a good time to fill the CEO role and looking forward to it. Okay.
And so tell me, a couple of things actually. One, any other changes to the board or management at this point? And two, are you going to be plowing your own furrow? Do you need to shake things up and form it in your own image, or is the path well-defined and established?
Really no other changes in senior management or the board of directors other than Jeff will be retiring. So no changes there. We've got a very well-seasoned board. Everyone's been with us for a number of years. In fact, we still have some of the founders with us on the board. So no changes there. As far as going my own way and reforming the company, I really don't see really any big changes coming forward. I think we will probably spend a little more effort and time on research and development, and maybe we can talk about that a little bit later on. That's very near and dear to my heart. I think the industry has been a bit stagnant in that arena. And, the industry is not that old when you look at the in situ aspects of it. In situ really was born about 1963. And since that time, not many changes have been made. So it's time. If we're going to be more competitive across the globe, we've got to do a better job there, not just with URE, but with other in situ companies around the world. We've got to find better ways, more effective ways, more environmentally friendly ways to manage our business. So, going forward, I don't see a lot of changes other than perhaps with R&D trying to strengthen our position there.
Well, let's talk about that now. We can get on the projects, and most of your shareholders and followers will understand your two flagship projects. But R&D, you're saying we need to improve, we need to change, we need to work with other ISR producers around the world. To what end? What are you trying to do?
ESG is becoming so important. It always has been, but now it's becoming even more important to the investment community. So I think we owe it to them. We owe it to our shareholders to be able to advance the technology. In situ is a fantastic technology. In fact, most people, when they come out and tour our mine site, we take them out there and they say, wow, this is not even a mine. What are you talking about? This is not a mine. It's water treatment. But we literally have deer and antelope out there playing in the well field, sage grouse out there. It's covered in grass. So when you drive by, it looks like some beehives out there, and those are the wellheads. So we've already done a fantastic job in that regard. But there are some criticisms that we need to address, and we need to get stronger. Water treatment's one of them. In our industry, we do use some water. And in the arid West, especially, we need to do a better job of reducing that. Groundwater restoration, we need to find better ways to go about doing that. So we use less water, so we do a better job of restoring that groundwater when we're done. And even simply the economies of production. Not much has been done to change that in the last 40 years. I think that's probably because the market has been so hot, so cold, so hot, so cold. There's really not been a great even price for an extended period of time where companies have been able to change their focus from either surviving or ramping up production, change the focus from that to R&D to try to make improvements. And so we need, as an industry and as a company, to do a better job of that. And URE Energy's been a leader in that regard. We've done a number of things from the regulatory perspective, but also from the technical perspective over the years since we started operations that have allowed us to reduce cost and to have a better ESG footprint out there at the site. Some of the things we've done, ion exchange design, we've dramatically improved that. Class 5 water treatment and disposal. We're already recycling a tremendous amount of water out at the site. And a number of other things that we've been the leader on, well abandonment technologies. We've led the charge in that regard as well. So we're looking forward to continuing R&D. In fact, last week we did have a press release that called out only 2 of the projects we're working on. We're working on other projects, but 2 of the projects we're working on, one of them is water treatment. Even though we've made great strides in water treatment, we believe we can do even better. In fact, we're looking at an additional 90% reduction in water consumption at the site. And we've made great strides in that, and we're in advanced engineering at this point. And so we're really proud of that.
So this is an interesting area to kind of dig into, right? Because there's a big conversation around ESG, has been for the last sort of 12 months. And some people sit on the sense of, it's just rebadging what went before. And others are going, mining more broadly needs to improve its image and the way that it works. Okay. And I guess we're talking a little bit about over here about, can we improve efficiencies? That's always good, but can we also, be better at doing what we're doing for all the right reasons, right? And I just wonder when you talk about whether it be water recycling or filtration, I imagine the economies come from the filtration component, because the more you can extract, the better. If you're reusing the water, it's kind of like, well, that's great. You're using less water, but that's not a big cost center. So, where do you sit in the debate between? What's the phrase people use? If you go woke, you go broke, right? I think that's someone thrown into various conversations with us and say, is the ESG thing mutually exclusive from the economics, which I guess is where investors want to sit, or is it? Are they able to work hand in hand together for all the right reasons?
No, they have to work hand in hand, and if they don't, if it doesn't make economic sense, then we drive ourselves out of business. So. If you go woke, you go broke. That's a great quote. I've not heard that before, but I'll have to use that. But no, they have to go hand in hand. And you're right with the water treatment. The cost of the water is not the issue. The water is essentially free. We're not charged for that. But the improvements in the filtration, that allows us to inject more water, recover more mineralization quicker. So your recovery rates are higher. The cost goes down, less well maintenance. That's all fantastic. In addition to that, the less water we have to dispose of, the less infrastructure we need on the back end to be able to handle that. And in our case, we use deep wells. At Lost Creek, they're about 9,000 feet deep. Those are expensive to put in. They're expensive to maintain and operate. If you take a look at our SK 1300 that we put out, you're going to see that the cost of a deep well is about $3.2 million. We don't want to put those in. They're expensive. And when you drill a well that deep, you never know exactly what you're going to get either. So you might get a well that'll take 5 gallons a minute wastewater, or you might get one that takes 50 gallons a minute. It's a bit of a gamble when you drill that deep. So we don't like that gamble. We like to keep our risk at the surface where they're tangible, where we can control them. So yeah, there's got to be an economic benefit to this. It can't be just ESG or you do go broke. The other project that we're really working on and we're really proud of is a well casing methodology. Last fall, we were starting up a drilling program, and it readily became apparent getting casing was going to be a challenge. We could get it, but it was going to be slow coming. There were allocations, and it was going to be very expensive. So we sat down and said, look, we've got to find a better way to do this. We can't be so reliant on this one particular type of casing. We've got to find a better way. So we did. We came up with a new casing material. And I'm going to be careful here. I don't want to say too much. I don't want to tip our hand on exactly what we're doing. I know some of our competitors are keenly interested in what we're doing. We have applied for a patent, a provisional patent, and we'll convert that next year to a full patent. But this casing technology has a lot of benefits. Historically, in our industry, we have used PVC as the casing. This is a different material, but virtually in every respect, it's equal to or better than the PVC. So it's going to give us tremendous cost savings for injection wells. We can't use it for production wells due to some technical limitations, but we can use it for our injection wells, which represents over 60% of our wells are injection wells. And the real benefit here is currently when we install a well, it takes a drill rig about 3.5 days of their time. By the time they drill it, ream it, case it, cement it, do all of that, we're looking at 3.5 days of rig time. But with this new methodology, we're looking at about 5 hours, maybe 6 hours of rig time to be able to put a well in. That's an incredible savings, cost savings. And going back to ESG, has tremendous benefits from the ESG perspective as well, because you don't have near the air emissions. You don't have the noise. You don't have the water trucks running back and forth, smaller mud pits. There's just so many benefits here to moving toward this technology. And I have to be careful to say, we haven't proven this out yet. On paper, it looks fantastic, but we have to prove it in the field. So right now we are going through permitting with the state of Wyoming. Once that's done, and we believe it'll be done in short order, then we're going to go out and test it in the field. And R&D by its very nature is challenging, and the outcome is never certain. But we're optimistic we're going to be able to do something beneficial here for the sake of ESG, but also so we're not so reliant on getting so many drill rigs and the cost associated with the casing and the limitations of supply. So we're excited about R&D. I think we've been a leader in the past. We're going to try to continue to lead the pack for the sake of ESG. But as you said, there's got to be a financial benefit involved as well to try to drive down the cost. We're not going to sit on our laurels and wait for the price to come to us. We're going to try to lower our price as quickly as we possibly can.
Well, with a C1 cash cost of 1634, you're already quite low, but I kind of like the striving to be better economically, right? I think that's really, really important because it shows intent. And I want to come back to economics in a bit, but I feel for people that are perhaps new to this story that we may be introducing here, we better just talk about the two projects, Lost Creek and Shirley Basin, and just give us broad economics on each, because I'm more interested in the business model about what you do there, plus with the inventory, et cetera. So give us the Lost Creek, Shirley Basin broad numbers first.
Yeah, sure. We've got two flagship properties. The first is Lost Creek. That's been in production now for a little over 8 years. It's been a fantastic producer. In fact, our recovery rates on that mine have been about 90%. That's fantastic for our industry. So we're really proud of that. And I think that's a reflection of the quality of our crew, but also the quality of the deposit. The resource there, the measured and indicated, we've got a little over 11 million pounds. And on the inferred, we have 6.6 million pounds. And that gives us about a 14-year additional mine life and above and beyond what we've seen so far. So it's permitted, it's built out, it's operating today. That's really important. I want to call that out. Our staff today is out there making pounds. Now, we have allowed it to reduce to a fairly low flow rate just in recognition of market conditions. So we've not been ramping up production there. However, as I alluded to earlier, in the fall of last year, we said, look, the price of uranium is improving. We need to be more ready to go into production. So we started a drilling and construction program at Lost Creek, and that's ongoing. We expect the drilling and well installation in Header House 2-4 to be complete next month. And then we're going to be working on the header house, and that'll be done in the summertime, and we'll be ready to ramp that up and pull the trigger. Really importantly there, before I switch gears over to Shirley Basin, we have recognized the impact of inflation. We've recognized the impact of supply and of materials and the shortages and the delays. So we've instituted a program where we are keeping tabs on cost and also the timing of getting those materials in. And so we have got everything we need for 2-4 ordered and on either ordered or on the ground. Same for the next header house, 2-5. Everything is ordered for that house. Even going out to the next header house 2-6, we have a short list of long lead items. We've already gone ahead and ordered those. Those typically are the electrical things like MCCs, transformers that are so far out, but we've got them ordered. We don't want to be behind when it does come time to construct that. So that program is up and running. In addition to what's permitted at Lost Creek, we are working on additional areas to go out and mine at Lost Creek East and KM. And so the permitting there is well advanced. We have 2 of the 3 major permits we need to be able to expand the footprint of that mine. But switching gears over to Shirley Basin, we're really happy with Shirley Basin. Its permitting is complete. We have all 3 of the required necessary major permits in place to be able to begin construction. It's got 8.8 million pounds of measured and indicated resource, really nice grade, greater than 0.2. And so we believe it's going to be a very good producer. In fact, it is a historic in situ mine. We believe it was probably the first commercial in situ mine in the US, starting back in 1963. And they produced well over 1 million pounds with in situ technology. So we're excited to bring the technology back to where it was born. It is a brownfield project that actually helps us reduce cost. The roads are there, the power lines are there. We even have a couple of nice buildings out there, and it's a really shallow deposit that's completely drilled out. We don't need to do any exploration or delineation. So for all those factors, it actually drives the cost down below what we're going to experience at Lost Creek because of all of those facets. So we'll likely construct it as a satellite facility, even though the permit allows us to build it out as a full plant. We'll probably just do a satellite facility because it's so close to Lost Creek that we'll be able to just load resin with uranium and then truck it over to Lost Creek for production. And that way we don't have to build out the back end of the plant. So to get Lost Creek, switching gears back to Lost Creek, to get it up and running, we're looking at between 6 and 9 months to get it up to 1 million pound a year run rate. Shirley Basin, since we need to build it out, we're looking at about 15 to 18 months to build it out to get up to 1 million pound a year run rate. So 2 great projects, both are proven in situ producers. Lost Creek has produced over 2.7 million pounds with in situ. Shirley Basin has produced tens of millions of pounds conventional and over 1 million pounds with in situ. So they're both proven producers, and we've got a great crew, tremendous experience. We've been able to keep those retained. So when we do ramp up, it should be a relatively easy process.
Right. Yeah. I remember speaking with Jeff previously about, I'm going to let some people go, but retaining the more experienced ones for this moment in time when things start to ramp up. But so Lost Creek has been sort of ticking along because it's harder to kind of start up ISR projects if they stop. So that's kind of ticking along. Just on, I get the 6 to 9 month time frame, but again, it was indicated previously about $14 million to kind of get up to optimum production of 1 million pounds on that. Is that still the case, or given your comments about inflation, et cetera, is that number changed?
Yeah, it's a bit of give and take with inflation, but also you got to mix that with the expenditure we've already made. So we're looking now at about $13 million to be able to ramp up Lost Creek. 13
additional million dollars. Got it. Okay. So I want to go back to some of the other quotes because I'm intrigued about how the market's moved and evolved even in the space of a year, right? So Jeff was saying, do you know what? Cameco have said $60 uranium is good enough for me. It's good enough for them. It's good enough for me. However, we can make a go of it at 50. So we're at and beyond those numbers now. You are, I know, have started the ball rolling, but has your perception of what you want to get, what you need to achieve changed, given inflation, given where you think it may go, given all of the other factors, including Section 232s and US uranium reserves and so forth, and all how those conversations have evolved. So what's the number look like today for you?
Yeah, so I mean, Jeff was right a year ago. That's spot on. But inflation is real. We see it. Since we are an operating mine, we know exactly to the penny what everything costs. You know, pumps, electrical wiring, the sensors, monitors. We know to the penny, and the cost is real. One of the biggest ones that we're concerned about is the price of oil. In the in situ industry, we use a lot of plastics, HDPE and PVC. Also, the drill rigs are burning diesel. And so we are seeing a real impact from the price of oil and gas and that impact on us. So, yeah, that price has gone up. Are we in the money today? I think the spot price is about $53. Long term is about 50. So no, we're not quite there because of inflation. That's not a number we're going to divulge precisely where it is, where we're going to ramp up, but we're close. We're getting there. And I should comment too, the spot price, it's been as high as 65 here in the last few weeks, and it's retreated from that. And I have shareholders and other people saying, John, why aren't you ramping up production? Well, it's not stable. And that's what I point out. And, the price has declined remarkably in the last few days. I think it's about to find a new bottom. But ramping up and sinking capital into a mine with the goal of selling into the spot is a dangerous game. I'm not saying we would never do it, but we've got to see higher prices and we've got to see some long-term stability in that spot price before we would be willing to pull that trigger. Historically, we've only sold into the long-term market. And then really that's our goal going forward. We want to sign long-term contracts with preferably with domestic utilities. That gives us stability. It gives us a reason to be able to sink that capital into the mine and ramp up production. So really that's the direction we're headed. One of my big goals for this year is to be able to get long-term contracts with utilities. And we're in discussions with them quite frequently, testing the market and seeing what we can get signed up for long-term contracts.
Right. Hopefully with a 6 or more in front of it. Right. If I look at your share chart, it's kind of like a lot of uranium junior share charts where SPUT or Sprott Physical Uranium Trust took off in August, September last year. You went on a run as well. When they stopped buying, you came down as well. When they started again a month or so ago, you went up again. Now they've stopped in the last 3 weeks. You've gone down again. That's a fairly familiar chart if you're a uranium investor at the moment. But it's just reflective of one aspect of the market, a group taking pounds out of the market. The more important group in the mix there is the kind of utilities who obviously need to make their play on this, and they're going to choose the timing as they have been doing for the last 3-4 years, and they're going to not share that with the world, not going to share the strategy with the world. So. Are you in conversations? Have you been in conversations? If you haven't, what's your expectation of how this has played out? We've seen a few RFPs come in the market, a few of them signed as well, but it needs something more than SPUT being active or inactive each week. So what's it going to take?
Yeah, I think you're pointing out an issue here, especially from the investment community. I think there's a real misperception that spot price is the market, and it's really not. It's only a very small percentage of the overall market. By far and away, the larger market is the long-term contracting. So hopefully investors who are new to this industry will take that to heart, but it does add a lot of volatility. I guess maybe the advantage of SPUT, the Sprott Physical Uranium Trust, is they are mopping up a lot of inventory and taking that off the table. So I think that is beginning to have an impact on the long-term price. That long-term price, it tends to lag behind the spot, but we're seeing it start to catch up slowly. I think partly because of Sprott, but also because of the geopolitics. So it'll be interesting to see how things go forward. I think Sprott will begin to raise funds again at some point here and be back in the market. And we're likely to see it continued volatility, which is unfortunately kind of natural for our industry, is a lot of volatility.
If I look, and I don't necessarily want to go down that track too much. You'll have talked about it in every single interview, I suspect. But here's the thing: what's interesting to me is you're a US producer. Obviously, your company was one of the two initiators of the Section 232, and Jeff talked very sort of aggressive, antagonistic type of language about what could be coming from the East. Turns out, if he was here, he'd be going, "I told you so," right?
Yeah,
that happened. I called it, and it has happened, and it will dramatically change the route which a lot of this, 308 or UF6 or enriched uranium flows. I suspect a lot of the Russian stuff's now going to flow a little bit east, and you, as a US producer, will be a beneficiary of what the US is going to have to do now in terms of securing, whether it be US uranium reserve or just for the utilities regular buying. So how do you take advantage of this situation? Does it help you in any way? Does it give you access to capital, North American capital, where you perhaps wouldn't have been before? How do you insert yourself into that ecosystem?
Right. Yeah, geopolitically, it's interesting times. So I think the way we insert ourselves into that is we have to be ready for production. We have to prove ourselves to the utility customers that we stand ready, we can ramp up quickly, and that we are reliable. And so we're making steps to do that, to prove ourselves. I think we already have proven ourselves to a large degree, but we have to continue to build that confidence with our potential customer base. So they say, hey, look, these guys are the go-to. The ability to backfill any supply disruption from Russia, or especially if that trickles into Kazakhstan and the former Soviet states, it's very limited globally. You could point to Canada and say, yeah, they're a prolific producer. They are. Cameco's got a couple of great mines up there. But beyond that, to ramp up beyond that, who's next? I mean, next gen, 5 to 10 years out for them to be able to ramp up. So we can't really call on them. Australia is somewhat of a similar situation. You've got the big uranium mine over there that it's in production.
Olympic Dam.
Olympic Dam, thank you. But that's not a uranium mine. That's a gold and iron mine, and they're not going to ramp up production just to get more uranium. So the production from there is pretty well fixed. You've got other operating mines there, but they have a limited capacity to ramp up and produce anymore. And you start looking at near producers, and you look at Boss. Okay, that's one, but that's not that big of a mine, and they have some technical matters that they're going to need to prove and overcome. So, and then you look maybe at Africa, and what are the opportunities there? But then you have to realize a lot of those mines are owned or controlled by China. A lot of that material could flow east, not to the Western world. So, we're in a bit of a precarious position right now with regard to global supply, with regard to uranium mining, conversion, and enrichment, all three segments of the fuel chain. So we just have to prove ourselves as your domestic uranium miner. Look, we're in a secure jurisdiction, we're permitted, we're proven, and we have to just keep singing that line and letting our utility customers know we stand ready to backfill that supply gap as it develops.
Right. I'd agree with you on all of that. I think Australia's got its own set of challenges. It really does. But what has happened, what we have seen with one of the Australian companies, Deep Yellow, John Borshoff, ex-Paladin, gone and made an acquisition, right? That's to kind of help give them optionality because, well, he's been telling the market for a while he's going to do it, so he's finally done it. But if I look at you, even if you get both your projects up and running, it's £2 million, right? It's okay. I mean, you're an established management team who've produced pounds before. You continue to produce uranium, albeit at lower amounts on Lost Creek. But how do you kind of up the ante here? Because you're kind of limited in a way in terms of what the potential is. You've talked in the past about M&A. I've seen some of your other interviews. I've been listening to Jeff. Very selective. We've got to be careful about how we do this because there's a lot of rubbish out there. Is that part of the management conversation or the boardroom discussion still, or are you just very conscious about, let's just get up and running, do what we do, and we'll just stay focused on that?
Yeah, so M&A is always a part of the discussion. I think in any commodity, especially in the juniors, M&A is always on the table. I think growing up in this industry, one of the things that really shocked me when I entered the executive world is simply the amount of M&A discussion and due diligence that's always ongoing. I think the viewers would be shocked at what's going on behind the scenes, not just with us, but with every company in the commodity sector. So it's not unusual. M&A is a part of the discussion. It's ongoing all of the time. But like Jeff, I feel the same way. There is a lot of rubbish out there. If we're going to do M&A with our company, we would really prefer that it be with somebody that looks like us, with a proven producer, with quality assets. And even if they aren't a producer, a quality enough asset that they can put it into production at some reasonable time frame and at a reasonable cost. We've never been much on marketing and touting blue sky and saying, 10 years from now we can do something. Our story has always been, yeah, we're a little bit small on the smaller side, but we are a very quality set of assets. They're proven producers and at a very low cost. So if we're going to go out and get married, we want it to be somebody that looks a lot like us. There's got to be a synergy there. There's got to be a reason to merge. Merging to get larger it's a reason, but it's not always the best reason. So we're looking for synergies. It's got to be in a reasonable, safe jurisdiction. We've got to be able to share management teams. So there's got to be a cost savings. There's got to be a technology benefit. There's got to be a good reason other than just getting bigger. So I guess I'll leave it at that, but we're very picky.
Yeah, no, I understand that. And what I'm wondering is, looking around sort of North America, we'll include Canada in there, okay? You're right, you've kind of got next gen, huge, but 5-10 years away from maybe getting into production because of, issues around licensing in Canada can be very difficult for uranium companies. Well understood. You've kind of got your you mentioned that, you kind of got your African place to African developers, perhaps you do have the licenses and permits that they require, but lower grade stuff, and it's not typically ISR. I just wonder where you look for this perfect marriage, because when I look at the other North American players, it's tough in terms of proven producers. Maybe you're the management team that can take over an asset and maybe make it work, but a lot of companies have achieved a quite meaningful valuation and feels like a lot of backfilling coming in, and the cost to you could be quite expensive. So is it a reality, or that you could get a deal done in North America, or would you have to look further afield, whether it be wherever that may be in the world?
Boy, you've hit on something that I spend a lot of time thinking about. Right now, valuations are maybe out of whack. There are some exploration projects and development, maybe not even development, just exploration projects out there, companies that their valuations are just off the charts. And it's not reasonable for us at this point to look at M&A with them. It just wouldn't be fair to our shareholders without some massive discount. And so it's difficult. You not only look at jurisdictions and market capitalization, but you look at technologies too. Our strength is in situ. Yes, we know the uranium space incredibly well, but our strength from a technology perspective is in situ. So should we be looking at conventional projects? Yeah, we should, and we do from time to time. But is that really where our strength lies? Perhaps we could get there. But if it's probably not at the top of our list. So it's a difficult conversation. It's a difficult topic because there are so few companies and projects that really satisfy the criteria I've laid out for M&A. But having said that, we keep our ear to the ground, and we watch and we listen, and we know the industry really well. And as opportunities come up, we'll pursue them.
Oh, here's a different question. Same question, but different way, right? Take the money out of it. Take the valuations out of it. How many projects in North America do you think technically work?
Oh, shoot. It's a pretty minimal list. I mean, if if you take the economics out of it, yeah, there are a number of projects that work.
Oh, take the value out of it, not the economics. Take the valuations out of it, but it needs to work economically, right? It's a small list.
It's a small list.
Is it a handful?
It's a handful, half a dozen or so that work. So it's a really small list. There's a lot of technical risk out there. There are a lot of wannabe miners who have fantastic technical teams, great management, but they've not proven themselves yet. It's a very, very small list in North America. And I would say the same thing is true probably in Australia. It's a pretty small list of projects that we think have good technical merit that we would consider for M&A.
Yeah, it's interesting, isn't it? I think that's probably about right. However, the valuations are there's no same thing. It's just your view. You've been around the block. You know what things, the realities of how things work, and you've been involved in lots of aspects of the company. So if you're looking at the market now, this uranium market now, there's a lot of fervor and excitement about the potential of uranium, as there should be. It's been thus for the last 3 years or so. People are getting very, very excited about it. What do you think people looking in must be thinking about this, about the uranium market at the moment, and what do you think they should be paying attention to? Because forget the BS and the promotion and they, buy today. What should they be looking at? What's important and what's not?
Well, let me start with an economics test. When I look at companies for M&A, one of the very first questions that I ask is, the projects that this company has, were they in production in the last cycle, 2007, when the price was so high? And if not, why not? If they couldn't be in production then, why should I think that they are worth looking at now? So I would encourage people out there that are new to this space, look at the history of the projects and were they able to produce or not.
You mean like at all or at certain numbers? I mean, I think I've heard companies who've said we produced, I don't know, 100,000 pounds. Is that good enough?
It's got to be meaningful because there's a whole list of companies out there that attempted to go into production and they produced, hundreds of pounds or a few thousands of pounds. It's irrelevant. They need to show that they can produce hundreds of thousands of pounds in a good market. And if they can't make that demonstration, then I'm not saying you shouldn't invest. I'm just saying that you should do a deeper dive and understand why. And can management explain that adequately before you invest today? But more broadly, to answer your question a little more fully, I think right now investors are looking at the geopolitical situation that's out there, as they should. It is meaningful. It's a price driver. The implications to our industry could be massive, and it could really drive the price for many years to come. But setting that aside, because that's it could be more near term, and there's a lot of volatility there. I think what's maybe more important for the long-term investor to look at is the green energy aspect of nuclear. We can't ignore that. There's going to be a lot of volatility up front, but for that long-term investor, where is the price going to go? And I think if you take a look around the world where countries are looking to get their energy from, even before the Russian invasion of Ukraine and the gas shortage that comes from that, a lot of countries around the world were really beginning to move toward nuclear because people were beginning to understand if you're going to get to carbon neutral, nuclear has to be a part of the story. There's no other way to really get there. And so countries like South Korea, they're jumping back into nuclear in a big way. France, and Macron was just reelected. He's saying we're going to go forward with nuclear. We're going to keep the existing plants open as much as we can, and we're going to build a bunch more. China, holy cow, China is the gorilla in the room. They've said they're going to build 150 reactors in the next 15 years. Just 2 weeks ago, they said they're on track to accomplish that. Those are crazy numbers. That's going to have a real impact on uranium supply and demand for many decades to come. So for the investor, look at the geopolitics. There's going to be a lot of volatility associated with that, most likely in the coming weeks, months, even a year or two. But in the longer term, be very aware of the impact of the decarbonization of the global economy and what that means for supply demand. I think the long-term view on nuclear is very bright. And I think it's a great reason to invest, especially in the long term.
No, I'd agree with you. Like we've been running a uranium show weekly for almost 3 years now, and I think that it's interesting to see the narrative change over that time. And you've recently had that kind of whole EU taxonomy, including nuclear and gas as a green energy solution. And I think, as you say, even before Russia-Ukraine happened, there was a steady increase in energy prices, which has caused politicians to actually pay attention to, the energy mix. So it's been fascinating. And if anyone wants to go and see that, we talk weekly at cruxinvestor.com. You're welcome to pop along there. Well, look, John, I'm sort of conscious of taking up your time. It was great to catch up on UR Energy and see where you guys are at and just sort of moving things along. I know you talked about sort of just, allocating capital and time to move things along and start building, et cetera, getting yourself ready. But it's not full throttle yet. Is that right?
That's correct. Yeah,
right.
We're waiting for a stronger market signal. And
what is that signal? Contracting with a 6 at the beginning.
Contracting.
No number given. Well, look, stay in touch and let us know how you get on. Obviously, it's a fascinating marketplace. Geopolitics is truly astounding, and so understanding how that all fits together, it gives us some sense of timing, gives you a degree of comfort and confidence when investing in here. So, John, appreciate your time. We'll see you soon.
Great to spend time with you. Have a good day.